Meet John. He worked overtime for an entire year. He saved up $10,000. He opened his banking app, made the deposit, and went to sleep feeling like he'd finally done something right. Here's the problem. That money isn't sitting in a vault with his name on it. The bank took it, and it's already out there working, just not for him. Today, I want to walk you through exactly how this works, a corner of the financial system worth $2.5 trillion that almost nobody's heard of, and more importantly, what you can actually do about it. Let's start with the basics, because there's a detail in how banks operate that most people sort of sense, but rarely stop to actually think through. Imagine you hand the bank 10 bananas to hold for you. You walk away thinking your 10 bananas are safe, but the bank only keeps one banana in the vault. The other 9 get lent out immediately to someone else, and the bank charges interest on them. You still see 10 bananas in your app. In reality, only one exists. That's fractional reserve banking. By law, banks are only required to hold a fraction of your deposits on hand, historically around 10%. It's been the foundation of the modern banking system for over a century, and for most of that time, it's worked reasonably well. But here's where it gets more interesting. Jamie Dimon, the head of JP Morgan, made a comment recently that got the whole industry talking. He warned that when you spot one bad loan blowing up, there are usually more hiding behind it. What he's pointing at is this. Traditional banks today are heavily regulated. There are real limits on who they can lend to and how much risk they can take on. So Wall Street built a parallel system with far fewer rules that handles the lending regular banks won't touch anymore. Think of it as a parallel banana market. The regulated bank won't lend bananas to someone who already owes too much, but this other market will, and it charges interest of 15, sometimes 20% to do it. The vehicles that run the system are known as business development companies, a way for large financial institutions to take on risk while keeping it off the balance sheets of regulated banks. Many of these funds also charge a flat fee for managing the money on top of a share of the profits generated by those high interest rates. Consider the scale of the problem. The financial crisis of 2008, the one that caused the worst global recession in decades, was roughly an $800 billion problem. This shadow banking system today is worth $2.5 trillion, more than 3 times larger. When it works, the returns are enormous. When it fails, the pattern has always been the same. Governments step in, interest rates get cut, money gets printed, and the institutions end up rescued. And you, sitting there with a savings account earning a tiny fraction of a percent, end up absorbing the cost through something most people never connect to any of this. When governments print money to stabilize the system, they dilute the value of every dollar already in circulation. That's inflation. And the math behind it is fairly simple. Say you have 10 bananas, and they represent 10% of all bananas in the world. You're holding real value. Now the government creates 90 new bananas to fix a crisis. Suddenly, your 10 bananas represent only 1% of the total. You didn't lose a single banana, but each one now buys much less than it used to. If inflation runs at 5% a year and your bank only pays you 1% interest, you're losing 4% of your purchasing power every single year. That's not bad luck. That's simply how the math works. $10,000 today, in terms of purchasing power, would be worth a little over $6,000 in 10 years if inflation stays at that 5% rate. People who understand this tend not to hold cash as their main asset. They prefer things that rise in value as more money enters circulation, things like businesses, real estate, and stocks. When the number of bananas doubles, the price of real things rises right along with it. That's the mechanism that protects them. Understanding that mechanism is one thing. Actually using it is another. And that's exactly the kind of thing I cover every week. So subscribe if you don't want to miss the next one. Now let's get into what you actually do with this. Before I show you the numbers, there's one behavioral pattern that wipes out most people's returns, and it's not about picking the wrong stock. A study from JP Morgan found that while the American stock market has historically returned somewhere between 8 and 10% a year, the average retail investor captures only about 2%. That gap isn't explained by bad luck or bad timing. It's explained by behavior. Don't wait for the perfect moment to start. If you miss just the 25 best trading days over a 20-year period, your long-term returns are nearly wiped out. The research on this is consistent. Time in the market matters far more than trying to guess the right moment. Stay away from high volatility bets too. Trading apps are designed to make margin trading, hot stocks, and options look exciting and accessible. Decades of data tell a different story. Diversified, low volatility investing outperforms over time. It's boring, but it works. Then, automate it. Keep 3 to 6 months of expenses in a regular savings account so you always have a cushion and never have to sell during a downturn. Then take whatever's left over, set up a recurring monthly purchase into an index fund, and let it run on its own. You buy when the market's up, you buy when it's down. You stop thinking about it. And watch out for confirmation bias. Once we invest in something, the brain automatically starts searching for news that confirms we made the right call, while quietly ignoring the warning signs. Even seasoned investors have admitted this bias caused them to miss major opportunities. The key is to look for information that tests your own idea, not just information that supports it. So what do you actually do with all of this? You cut out the middleman. Instead of handing your money to a bank so it can invest in the global economy and keep the profits, you invest in that economy directly. And you don't need to live in the United States to do it. Anyone with an internet connection can open an international brokerage account and buy an index fund that tracks the American market. When you do that, you become a partial owner of the 500 largest companies in America. Names like Apple, Microsoft, Amazon, and yes, JP Morgan itself. The historical average return on this type of fund runs between 8 and 10% a year over the long term. If you start from zero and contribute $250 a month at an average return of 8%, after 30 years, you'll have put in $90,000 of your own money, but your account will be worth more than $350,000. That extra $260,000 didn't come from working more hours. It came from the same compounding mechanism the bank uses with your deposits, except this time, you're the one collecting it. One more thing worth keeping in mind. Every time the market has dropped sharply, whether during the crisis of 2008 or the crash caused by the pandemic, it's always gone on to recover and reach new highs over time. The biggest downturns weren't the end of the road. They were a pause within a much longer trend. And here's something just as important. The biggest investment you can make isn't only financial, it's the one you make in yourself. If you sharpen your skills, learn to automate processes, or build a business of your own and manage to increase your income enough to go from contributing $250 a month to $800, you completely change your family's financial future. Your earning power fuels your investing power. That's the whole thing. This was never about trying to outsmart Wall Street. It's simply about removing the middleman between you and your own bananas. And if you got something out of this, subscribe and turn on notifications so you catch the next video the moment it drops. I've got more of these breakdowns coming, and you won't want to miss them.